it's going to reflect more than greed though. It's going to reflect fear. And fear, why fear? Well, fear of currency collapse. I mean, anyone who had gold or silver during the Weimar hyperinflation and kept that gold throughout, they became well off. They didn't lose everything. It was the people that had paper that lost everything. Wednesday, May 14th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, today we're going to look at a BBC article about gold, and I have to say it's fairly balanced. There's some very good comments there, but the overall picture that the article gives is that gold could be evolving into a bubble. So that's what we're going to look at, whether gold is becoming a bubble or in my opinion, whether gold is actually revealing that the everything bubble is bursting. And we're going to reference a pocket book of gold by Jim Sinclair. There's a great part about what gold is in this book. Before I start, I just wanted to give a shout out to Dirty Man Safe, one of our affiliates. With Dirty Man Safe, you're able to keep some of your valuables safe. It's a really easy, convenient, and really efficient way to keep your gold coins or bars or other things safe. I'm not saying you should keep everything in a Dirty Man Safe, but yeah, have a look at it. There's a link below in the description. Special link that will give you 10% off. And I think when you buy Dirty Man Safe, you get also special gift. And they've got all different kinds of sizes now with Dirty Man Safe. Yes, is gold in a bubble? So I got sent this article. I usually don't follow the BBC. Someone sent this to me via Patreon. So yes, if you want to get in touch with me directly, and it's not to do with business with the channel, yes, there is an email on the YouTube channel where you can contact me, but it's more for business inquiries. But if you really want to have access to what I think and have a chat, think about joining my Patreon. It's as little as $1 a month. So someone on Patreon sent me this article, and I read through it, and it's a big article, 13th of May from yesterday. And it says gold is booming, but investors lured into the hype, by the hype, could lose out, warn experts. So you can see that it's saying it's dangerous. Be careful. And I'm not going to read through it because I'll let you read it. I'm going to put a link to it in the description. You can go through it, and they have some very good points and for gold as well. So it's a balanced article, but as you see, the theme of the article is that gold is dangerous, volatile, and could be close to becoming a bubble. So it says here towards the end of the article, could the bubble burst? Some analysts do think prices will ultimately fall significantly. John Mills, an industry expert at Morningstar. Well, Morningstar, they're not a bullion dealer. Morningstar, they're like a stocks and bonds fund. They don't really like gold because gold is a physical... Yeah, it's a physical asset that's outside the financial system. But anyway, what does he say here? Well, it says he made headlines in March when he suggested the cost of an ounce of gold could drop to just $1,820 over the next few years. His view was that as mining firms increased their production and more recycled gold entered the market, the supply would increase. At the same time, central banks would ease off their buying spree while other short-term pressures stimulating demand would subside, bringing prices down. Those forecasts have since been revised upwards slightly, largely because of increased mining costs. So they mention all the bullion banks revising their prices. For example, they mentioned Goldman Sachs saying that it will reach 3,700 by the end of this year and 4,000 by mid next year. They also, I think, mention the fact that it could hit 4,500. So, as I said, they're balanced. But what about this argument from John Mills that supply is going to grow and bring the price down? Well, I will counter that by saying that gold stock to flow ratio is like over 60 years. What does that mean? Well, that means that there's more than 60 years of gold production around in supply. Even though gold is a very rare precious metal, it's the most abundant one. It's the most abundant commodity out there because all the supply that's ever been mined, most of it, 99%, is above ground. Of course, a lot has been lost through shipwrecks and other things. People have buried it and no one's found it yet. So the stock to flow ratio means that the price of gold is not very heavily, well, it's not affected at all by an increase in supply. Very negligibly. It's not like other commodities, and that's why it's money. That's why it's so stable. Yes, back during the gold rush in California, 1849, the 49ers, there was an abundance of gold in California, and it drove prices higher in California, but it was more of a localized affair. It didn't really affect the world price for gold because of that. And the other thing I would counter Mr. Mills with is that there hasn't been a big gold discovery for over 20 years, and the mining sector has been moribund for the last 10 years or more, and there's been a very little capital put into the sector in order to find new discoveries, to develop new properties. So I think it would take more than just a few years to get the supply growing. And notwithstanding the fact that it wouldn't really have much of an impact on the price of gold. Gold, in my opinion, is reflecting fear in the everything bubble, that the everything bubble is going to burst. So what is the everything bubble? Well, it's the bubble that Mr. Mills, I don't know how old he is, but I would say the majority of investment managers, people who work in finance, they've never seen a bear market in stocks or a bear market in bonds. I didn't either. I started in the late 80s, early 90s, so I didn't really experience much of a bear market in stocks nor bonds. Yes, the bond market was still under the watchful eye of the bond vigilantes when I started out. But looking back at the long-term yield, let's say, of the 10-year treasury, you can see that we've been in an everything bubble since 1981. And the mantra and the strategy from the financial sector, from Wall Street, from people like John Mills, is that you have to keep buying stocks. It doesn't matter if they crash or correct. you buy the dip, and it has worked for like 40 years, but I think that's changing. And why is that? Well, because if you look at the chart of the 10-year yield, that yield's starting to go up. It started going up about 4 years ago in 2020, and we've broken the trend line that you see here from 1981. And the bond market is the most important financial market out there. It determines where stocks are going to go. And the reason stocks have been in an everything bubble is that bond yields have been, well, up until 2020, had been going down. We'd had lower highs, lower lows, and what that did, it allowed everyone, including the government, corporations, individuals, financial institutions, to roll over their borrowings at an ever cheaper cost. And what that did as well, it injected liquidity into the system, more liquidity, higher prices, hence the everything bubble. But I was thinking about talking of the bond market today because it's actually flashing some warning signs. And one market that you need to keep an eye on is the Japanese government bond market. And I think that's also flashing big warning signs. I think we could have a summer of chaotic market activity, mainly because bond yields are starting to rise again, not just in Japan, but here in the UK as well. As you can see, we're well above really the levels, just above the levels that we saw in 2022 when we had a crisis. US Treasury yields are not really playing ball. We're approaching 4.5 in the 10-year. The next key level that's important is 480. And what's that got to do with gold? Well, this is where I bring in Mr. Sinclair's, the late Jim Sinclair's book, A Pocket Book of Gold, a survival manual for monetary mayhem. And I think we're right in the middle of monetary mayhem, to be honest. And all the stuff we see on the side, like tariffs and geopolitics, budget deficits, and deals with Saudi Arabia, deals with China, these are just symptoms of the people in charge trying to survive this mayhem because they know it's coming, so they're trying to put deals together. And what they tell us in public is probably just for public consumption. What you need to know is that the system is in trouble. So I'm going to refer to a section here on page 70. And this book, I bought it years ago from Jim Sinclair's blog. It was about £30 or $30. But they're rare now. These books are rare, and I think you can find them, but they're very expensive, unfortunately. But it says here on page 70 what gold really is. And it goes to the crux of this question, whether it's a bubble or not. And personally, I don't think gold is a bubble. Gold is going to reflect a bit of greed, of course, when it really, when there is a real gold rush, because the public is not involved. That's what the BBC article doesn't really say. The public is not really involved. It's going to reflect more than greed though. It's going to reflect fear. And fear, why fear? Well, fear of currency collapse. I mean, anyone who had gold or silver during the Weimar hyperinflation and kept that gold throughout, they became well off. They didn't lose everything. It was the people that had paper that lost everything. So that's where I think we are. So let's go through how gold is a revealer of falsely stated wealth. And that's the everything bubble, the falsely stated wealth. When wealth is overstated and expectations for future wealth are unrealistic, fiat currencies depreciate. That depreciation is borne by the citizenry who are forced to lower their living standards to compensate for both personal economic mismanagement as well as the mismanagement of the affairs of state. Financial and military overextension has a social corollary in overpromised Social Security, Medicare, overstated real estate, equities, affluence. As expense runs out of control, guarantees to the citizenry also explode as politicians seek to retain the privilege of office. But the promises of wealth are false. The belief that ownership of real estate is a ticket to fortunes is hollowed out for what it is, a myth. Wealth that was taken for granted suddenly appears ephemeral. The amount of currency which once bought certain things no longer does, but wages have not risen along with prices. Well, that's what's happening everywhere around the world, to be honest. Instead of wealth, citizens, well, except for the top 1%, maybe even the top 10%, they're still doing well because they have a lot of assets. Instead of wealth, citizens get saddled with a big chunk of government debt, i.e. debt created by mismanagement, and it's not improving. I spoke recently about budget deficits still running really high, 6 to 7% in the US, yes, in the US. The result is everyone pays more for food, fuel, and other necessities. Well, why is that? Well, because the currency becomes worth less and less because they issue more and more to cover those deficits out of thin air. And that's why having gold is so important. Government passes on the mismanagement of economic affairs to its citizens by devaluation. Yeah, you were that's what you're good for, unfortunately. I don't like to be rude, but we're just sheep being driven to the devaluation pen. That's what we are. Unless, of course, you refuse to be taken to that pen and you acquire gold and silver. Dollar cost average, I would say. As the imprisoned money manager Martin Armstrong has artfully stated, and I quote him, the decline in the value of a currency is in reality a free market tax, taking away wealth that is overstated. So currency can also be an indirect tax to compensate for the poor management of state, end quote. The corresponding rise in gold, especially when it is a global phenomenon, as it is now, is in effect a devaluation of all the world's currencies and a restatement of wealth on a global scale. So there you go, BBC. Yes, balanced article, but I don't think it's a bubble and I don't think gold is dangerous at all. There's more danger staying in the fiat currencies of the world. As is both presently and historically evident, the attempt to restate wealth to a lower level becomes a competitive event in its own right as nations fight to devalue their currencies against each other to reduce the burden of indebtedness. It should be recalled that when FDR lowered the value of the dollar vis-a-vis gold in 1933, America was the 9th nation to do so in a 3-year period. Falsely stated and assumed wealth, largely created out of the assumption of debts that cannot be borne, must eventually reset at a lower level. Populations, yes, you, bear the restatement of wealth through the expansion of monetary aggregates, causing a devaluing of the national currency that denominates their wealth. This happened to all currency holders, regardless if they personally assumed any debt. Gold rises because gold is a monetary proxy inversely related to a nation's currency. The burden of indebtedness is reduced along with the standard of living. Commodity prices increase. Debt deflation has become currency inflation. They are one. So there you go. That's how I feel about gold being in the bubble. And I don't think you should be worried about the price, where it's going to go. It's going to go a lot higher, of course, in my opinion, mainly because governments around the world are not going to get religion. Politicians are not going to get religion and cut spending massively and cut taxes and cut the size of government and stop interfering as well. There's a lot of interference. There's a lot of talk of sovereign wealth funds in the States, things that really governments shouldn't be involved. But everywhere around the world, the governments and politicians continue to interfere. So that's where my money is, more continued mismanagement of financial, fiscal, monetary affairs. And that's why I don't think gold is anywhere near a bubble. What it will do, it will reflect the falsely stated wealth that we've seen evolving for the last 40 years. I mean, 40 years ago, you didn't hear of too many billionaires. You didn't hear the word trillion as it pertains to the dollar. So that's where we are. And as for the markets, they're fairly quiet this morning. Won't go through them because I don't want to drag this video on for too long. But yeah, keep an eye on the bond market. Keep an eye on the 10-year yield, treasury yield, and also the JGB yield. I'm going to put a link to where you can look at them below in the description. And with that, I'm going to wish you all a very good day. Take care. Bye.